How do successful investors like Warren Buffett decide what a company is worth, whether they're being discounted or they're being sold at a premium? The answer is they look at discounted free cash flows in most cases. That is Warren Buffett's preferred method. It's the method that the investor he followed, Benjamin Graham, recommended. It continues to be the primary method that value investors like myself believe in. I completely appreciate and believe in discounted free cash flows representing the value of a company. Something that I use in my investing and something that I will continue to use. Now, driving and getting to a value of a company using discounted free cash flows is not rocket science, but it does take some knowledge of finance, some knowledge of some financial mathematics, and it just takes a really committed level of effort to learn how to do this. It's something that I have a background of being an accountant, educated in accounting. I have a master's in business. I have experience in working in industry. And some of these concepts I've really had to dig in to really understand. I encourage you to do the same because to know a company is to know their fundamentals and to know their financials. And the closer that I know the company's financials and their metrics and their fundamentals, the better decisions I make, the more money I make. So this is one of the key tools that I use in my investing. And I'd like to take you through my discounted free cash flow model and hope that it serves as an example. So let me show you the model that I've created that drives and calculates discounted free cash flow values for a stock. This is a model that I've put on my community homepage. You can download it, and I hope you find it interesting. Let me give you a quick tour, and then we're going to go get the information to fill in this model. The model really, I'm going to start at the bottom. We want to get to a determination whether a stock is being sold at a premium or a discount. In this case here, I'm going to look at a company, UPS. Most people are familiar with UPS because they ship packages to just about everybody's doorstep. And this is a company I haven't looked at, so we're going to look at these numbers, and these are going to be fresh numbers to me and to you as well. As we look at the model, this model uses a discount rate, and that's an important number that I'm going to cover in a little bit, but that really discounts the free cash flows to today's value. I like to look at the history of a company, both the free cash flow growth rate as well as the revenue growth rate. And using that history helps me determine how will I grow in my forecast, the cash flows for the first 4 years and the cash flows after year 4. The actual forecast of free cash flows will fit into this area, and I'll go through that as we look at UPS. That's going to drive an intrinsic value of all those free cash flows in the forecast and give me a net present value. I'll look at the cash on the balance sheet and take away debt from the balance sheet to get to an equity value that I could then compare to this company's market cap as well as share price. So let's go get the information on UPS and start filling in this model. To get the information I need to fill in my discounted free cash flow model, I need to go to the financials for UPS. I like using stock analysis. It gives me a clear, concise way of getting information on UPS. And I'm going to first look at revenue. Revenue for the last 5 years, it looks like they had been growing and then they kind of stopped growing in the most recent year. I'm going to take the year starting with 2019 as the starting point and then ending with 90 as the ending point to determine what their growth rate is on their revenue. And I'm going to update that on the model. Next, I'm going to look at free cash flow. Free cash flow, especially on this website, they make it really easy. It gives me the free cash flow here on this line. And I can see that it's really come down. And remember that I need to make a decision on, do I think this is going to grow or is it going to go down? UPS does make it a little tough because they don't have any consistency in their free cash flow. It's been 6.4 billion, 2.2, 5, 10.8, 9.3, and then down to 5. So the growth rate I'm going to go with for the first 4 years is going to be 6%, long-term 4%. Those are reasonable. And then my starting point for free cash flows, I'm going to start with the last year's number, increase it by 6% to get to a starting point of $5.95 billion. The cash flows are going to grow in the first 4 years by 6%, and then terminal value will grow by 4%. That sets up a intrinsic value of $146 billion. And adding the cash and then taking away debt, I'll get to an equity value of $126.9 billion. Compared to the market cap of the company, it's $118 billion market cap. The shares are discounted by 7%. So based on the fundamentals and the financial data that I found for UPS, I have a stock that is being sold at a discount of 7%. if I compare it to the forecast of free cash flows that I expect, and based on the growth rates of those cash flows that I expect the company is going to experience, as well as the discount rate that I've applied, that's a quick way of seeing if a stock is very highly discounted or being sold at a premium. Another comment I would put is oftentimes very well known companies like UPS or Apple that investors really are comfortable with tend to sell closer to their fair value. And it's okay to buy a company at a fair price that is a great company and really fits your portfolio. You also see that companies that are very unknown and maybe are smaller in size tend to be really discounted. And that's because investors are not as comfortable. It's a new company. Are they going to make it? It's not really recognized. They don't have a lot of brand behind them. And you would see that. So this is a way of helping an investor, of helping me make a decision on whether to buy UPS or wait for the stock to come down. 7%, it's not a big discount. And I think the stock market at the present time is rather expensive. So I'd probably hold off on buying UPS. But really, the lesson of this video is really to create a discounted free cash flow model using a company. And these are numbers that I hadn't touched before I started filming this video. I hope you found the video interesting. Please provide feedback and ask questions if you have them on how I've created this discount free cash flow model and how I drove the valuation of UPS. Thank you for watching.